Now we have Shweta Jain, who's writing to us from Chandigarh, and she is asking us if it is a good time to buy debt funds with least credit risk to target annual yield of around 8%. So there should be very limited downside to the valuations that she's talking about. And it is, of course, in the rising interest rate scenario that we are focusing on. Mohit, what would you suggest? It's a very definite return also that she's asking here.
Look a little tricky, Sonal. Honestly, I think the expectation is still a little off what the current YTMs are in the portfolio. And let me also caution all the viewers out here that in a rising interest rate scenario, the more the long nature of the fund, which is the higher the modified duration or the maturity of the fund. So categories like income funds, medium-term funds, even dynamic bond funds to a large extent, they will deliver some amount of negative returns as interest rates keep going up. So a viewer has to be, or the investor has to be extremely cautious in terms of selecting the debt funds. Either you be at the extreme short end if you don't want the interest rate volatility in your portfolio. High credit quality is fairly doable if you buy a money market fund or a ultra short term fund. But the problem is the yields are not that attractive and you won't get that 8%. At the long end, then you have to go with target maturity funds, as I told you, but you have to sit tight and ride the interim volatility, because as interest rates move up, you will see some drawdown on your funds, or even on the debt funds you will see negative returns, or you could see negative drawdowns. So investor has to be very cautious about that. But if you hold tight till the maturity, then a 775 kind of a return pre-tax is doable currently with the YTMs which are available in the market.